CBIZ presents One to Grow On, quick strategies for your business.
Hello, I'm Susan Afsek. With me today is Mike Zeleznik, a director in our Accounting, Tax, and Advisory Services group. Welcome to CBIZ. Today we'll be discussing the importance of value planning. Mike, could you tell us a little bit about what you do?
Sure, Sue. But before I tell you what I do, let me tell you what I don't do. My colleagues will prepare financial statements or tax returns for corporations, and what I do is utilize the information in those financial statements and tax returns to determine the value of a closely held company. Or perhaps we get involved with determining economic damages in a litigated matter.
So what circumstances may require you to determine the value of a company or an interest in a company?
There are a variety of circumstances, Sue, where we may need to determine the value of a company. For example, our clients are always buying or selling something, or perhaps they're interested in selling an interest in their company to key employees or selling an interest to a family member. So those are transaction-related valuations. There could also be succession planning, whereby the senior generation in a family is looking to transfer their business to their children. And so they may be engaged in a process of gifting shares of stock over a period of time, or perhaps selling some stock to their children. Another example might be annual administration of certain planning concepts. For example, there might be a buy-sell agreement entered into among or between a group of business owners who may or may not be family members. And so in the buy-sell agreement, that document may require that the value of the company be established annually. Some companies are owned either partially or wholly by an employee stock ownership plan, or more commonly referred to as an ESOP. And the Department of Labor requires that the value of the shares of the company owned by the ESOP be determined at least once a year. So we may do a valuation for that purpose. Another purpose could be for income tax. For example, corporations that are taxed as C corporations for income tax purposes, when they convert their tax status to S corporation, there's something referred to as the built-in gains tax. And so it's important to understand the value of the company's assets when the company converts from C corporation to S corporation. And that value is an important number to have for a period of 10 years. Another example of importance of valuation may be where an individual contributes an interest in a closely held company to charity. And we need to determine the value of that stock for purposes of taking a charitable contribution deduction on the individual's tax return. That individual can't get a value for his shares by going down to Charles Schwab and plunking them on the counter and say, what do the markets tell you is the value? That's our job. Another example could be in a litigated context, in a divorce case, where there's a business owned by either the husband or the wife, and at the end of the process, one spouse will retain the business and the other spouse will retain other assets. The value of the business is important to be known in that process of splitting up the assets in the marital estate. Another litigated matter could be where 50-50 shareholders have come to an impasse as relates to their relationship, and they've decided to part ways, and one owner will buy out the other. And if they don't have that buy-sell agreement that I referred to earlier, then it's at this time that we need to determine the value of a 50% interest in the company. Speaking of shareholders at an impasse, sometimes a majority shareholder has a little difficulty with a minority shareholder, or in the alternative, it could be vice versa, where the minority is not happy with what the majority shareholder is doing. And so they get in a fight, and it's at that time that we generally are asked to determine the value of the company and the value of the minority shareholders' block of shares. So those are, as you can see, a breadth of different types of circumstances where value of a closely held company or an interest in a closely held company may need to be determined.
So Mike, do any of your valuation analyses get challenged?
Of course, in a litigated context, certain plaintiffs or defendants may not agree with the opposing expert's opinion, and it turns into a challenge. And so I've been to court many times and presented the analyses, the foundations for the analyses, and at the same time also looking at opposing experts' valuation report to provide counsel with observations about what the other appraiser may have done. So in the litigated context, our work will always be challenged.
So you've testified in court?
I have, Sue. I've testified here in Northeast Ohio in all of the common pleas courts, as well as the federal courts in Cleveland and in Akron. And I've also testified in the United States Tax Court in Washington, D.C.
Wow, the tax court.
Yeah, that was fun. And interestingly, our client was the Internal Revenue Service.
Mm-hmm. So Mike, what distinguishes you from other experts?
It's got to be the gray hair. That's what I think. But seriously, as I've worked with attorneys, for example, in the confrontational setting, they have shared with me that when I present the analysis, the opinions, and the conclusions to a jury, the jury really understands what I say because of the way I say it. And it's important for a jury to understand the complicated financial engineering that goes on in many of these types of situations. And so what it really is clarity in presentation.
And are there other economic studies and analyses that you get involved with?
Let me give you an example of something that we're working on currently, whereby a manufacturer is making a product and shipping it to its customers, but it received a bad part as relates to what it assembles. And so the bad part that it received from one of their vendors caused hundreds of thousands of units to be shipped that didn't work. There was a recall, and our client, the manufacturing company, lost a lot of money in getting the products back, fixing them, but more importantly, they lost customers because the customers didn't believe in not just the product that this company was making that turned out to be a bad product, but they made other products as well that the customers lost faith with. And so there was a business damage claim for loss of profits as well as loss of goodwill, all attributable to the event of receiving a bad part from a vendor. And so that's an economic study that is a damage analysis.
So when should a buyer or business owner or lawyer advocate reach out to you?
I should be consulted when the client or the lawyer knows that something needs to be done, and they may not be sure of exactly what needs to be done, but that's a good time to make a phone call so we can discuss the situation. Or alternatively, when there is substantial conflict, whether it be in a divorce case or in a business partnership where the owners just aren't getting along, or in an estate planning context. And of course, if somebody's looking to convert their business into cash and they're looking to sell, we can help.
Thanks for tuning in. I'm Susan Avsek.
And I'm Mike Zeleznik. If you'd like a little more information or you want to discuss a situation, please call me.